just so you guys can hear more. Oh. Hey, Mike, it's Mindy. How are you?
Hey, Mindy, I'm great. Thanks for having me.
Yes, thanks for being on. So I wanted to ask you what your thoughts are about the real estate market, and should people feel safe in investing today in real estate?
I think if you do your research and you find a great location and a great property with good return, and your reasons for buying it are long-term, I think it's a safe investment. Again, it's a long-term hold, and the rates over time will go up and down. So I wouldn't let rates as an individual facet of the investment determine your long-term decision there.
Do you feel strongly about real estate properties in Florida specifically, even being affected by rates?
I think rates are going to affect them similarly everywhere, but I'm a long-term investor in Florida real estate, and I continue to have a long-term outlook, and a positive one at that.
So, so you feel pretty good in the state of things are now. If someone is looking to get into real estate and maybe move out of other investments that they've been in, you feel good about it? You feel like it would be a good investment, and you feel like, what do you think about the rental space? I know there's a lot of different ways, multiple ways to invest in real estate. What do you think is kind of, we've got the Airbnb space, we have monthly rentals, commercial property, multifamily. Is there one that you think is better than the other?
I'm not personally big into the Airbnb because of the hands-on nature of it, but as far as it goes, commercial, residential, and again, residential income properties, if you find something that cash flows today, in this environment, then you've got the right location, and the financing works out. If it's financed and it's still positive cash flow with today's rates, you have the opportunity to refinance later down the road when the rates change, as they always do, and then lots of opportunities to earn an income on the properties you buy today.
So here's 7 reasons why real estate is a good investment. And I'll just kind of chat through these. There's, again, multiple ways to invest in real estate, like I said before, but there's a natural appreciation and just being able to do improvements. So maybe like flipping a piece of property, taking it, renovating it, or just adding new appliances, new windows, new roof. There's ways to invest and reach higher gains on the property. Would you say that's still positive?
Absolutely.
And I would say this is an excellent way to diversify your portfolio of having that nest egg, having real estate as part of an investment. Would you say going into retirement and being retired, do you think that having real estate is a part of your overall portfolio is still a good idea?
I think it's a good idea, especially with the different opportunities there are to invest in real estate. You don't have to own anything directly nowadays. There's lots of funds, whether it's publicly traded funds or even things like Fundrise or Arrive or things of that nature that allow you to buy into a property management company. And
yeah, absolutely. And even going back to the Airbnb, I just saw a fund that is geared around like luxury VRBOs and Airbnb. So again, going back to that first thing, there's multiple ways to invest in real estate. And so you're suggesting even just having it as part of your overall investment model within your securities versus physically owning the property itself. And one of the other benefits, and I'll even kind of join these together, is the taxes, because I know with real estate, you can have, if you have investments or rentals, you have a lot more write-off opportunities and to be able to offset some of your other tax obligations. Is that true?
Absolutely. In addition to the write-offs, a lot of the income you receive from real estate is favored far greater than just, income from a job or other passive income.
Absolutely. And then access to loans. So tying into that, now you have a collateral that you can use to secure loans for even other business opportunities. So it's an easier way for lending. How do you see the landscape of lending hasn't really been impacted that much by the changes in rates?
Well, yes, the higher the rate is, the far fewer people that are going to be able to find a property that's going to positive cash flow with the higher rates. So you have to look a little longer, maybe dig a little deeper, but they're out there. And it just takes a little more time and patience on the side of the investor when the rates are higher.
So would you, because I am, I'm guessing that we're going to see a lot more cash investors on the real estate side, just that in less finance investors, or are you seeing more of that? And even so, people that maybe have too much money in the bank, but they're not really into the stock market. What about real estate? Do you see cash buyers come in, more of an inflow to secure income that way?
I think there'll be a little bit more of that when it comes to residential real estate. We've seen kind of the opposite. We've seen a lot more folks borrowing to purchase than we did a couple of years ago, just because of the amount of money and the amount of demand that was here for a while. There were tons of cash buyers in 2021 and 2022. And coming into 23, a lot more financing deals coming through.
Interesting. So in terms of real estate passing generational wealth, do you think, is there any perks to, instead of leaving a money in the bank to your children or your beneficiaries, is there a benefit to leaving property instead?
There's lots of ways to do that, and that's kind of in your area of expertise with the trusts and the other vehicles to transfer that property. But property is a great asset to pass down to the next generation. And
you raise a really good point. This is why I like to have resources. This is why I like to have connections to people like Mike McCreary, who helps me when I have a question. Just today, I had a gentleman who received a lump sum of money because of an injury at work, and his case is settling, and he wants to buy a house and become debt free and go into retirement and utilize the money. So it's good that I can have these connections, and that's why you have to have a team, because if you, again, are designing that structure, that framework, one shoe doesn't fit all, and it takes a team of experts. And I think that's the one thing that the ultra wealthy have down, and that middle class America really needs to work on, is building a team. Your estate attorney, your real estate guy or girl, your CPA, your financial advisor, your banker. These are all members of your team. Your insurance. These things all matter, and they really need to work together. And you need to work with somebody that can work with everyone at the same time. It's really important. So some of the risk involved with real estate. One is the possibility of deflation. I know real estate, it's not a guarantee, right? But just like the stock market, the property values can fluctuate. But going back to what Mike said about it being a long-term investment, you anticipate that and you plan for that, right?
Yes. If you find something that cash flows positively today, over time, especially a long-term time horizon, it's you've got inflation on your side. As long as there's a government that's involved that controls money, you're going to have inflation, and so that's one of the main things pushing the values of real estate further.
Yeah, and we use a retirement analyzer software that factors in inflation into all of our planning. So when we're sitting here with a family today, or someone who's projecting to retire in the next 5 to 10 years, we are projecting what their expenses are going to be. And we can even calculate, like, let's say you do purchase a rental property. We can project how much it's going to be worth 10 years from now, how much you will have paid down your debt, if you have any, and how much you're going to have in passive income at that point once it's paid off. We calculate all the dates, all the data goes in, and it's just this giant calculator that shows us exactly where you're going to be. And it includes real estate as a part of protected assets. And I'm a big fan of real estate. I've made a lot of money in real estate myself, and I think it's a great way to build an overall nest egg and a strategy. And obviously there are things that can happen. You could accidentally buy in a bad location. Think if you do that in Florida, that's kind of a struggle. We are in a kind of a really great space. Sorry, I'm moving this camera all around. You could get a bad tenant. You could have structural damages. There are things that you could do, but I feel like if you work with an equipped realtor, and realtors are not all the same. One of the things I like about Mike McCreary is that he is financially sound. He has a lot of knowledge when it comes to things beyond just opening doors. He could definitely be, him and his team can offer you so much information when it comes to building out, not necessarily just selling you a house, but helping you create a financial plan and working with members to do that. So Mike, I really appreciate you being on the call with us. If you, do you mind me sharing your number with folks? If they have questions or interest, they can reach out to you.
Absolutely. Thank you, Mindy. I appreciate it. And I also agree with the advice. You got to have a team, and I appreciate you having me.
Thank you. Thanks for coming on. That's Mike McCreary, 772-486-5001. Again, Mike McCreary at Welcome Home Realty, 772-486-5001. Thank you, Mike. Be blessed, and thank you so much for sharing your input.
Thanks, Mindy.
Bye. Okay, well, there you have it. A little bit of information. So sorry to those of you on the Facebook Live, I had the camera wrong. I'm not the most tech savvy person. And as you know, Frank is not here with me today, and he usually takes care of stuff like that. But I'm back. You can see you all. And going to our next segment, which is one of my favorites. Why? Because I saw how amazing it played out in 2008. So we've covered banking, what we can expect there. We've covered brokerage accounts. We've covered real estate. And now I want to go into the insurance world and talk about specifically fixed annuities. And I have another informant I want to bring on the line to talk to and give us the backdrop of fixed annuities. But there's a reason why I want to talk about fixed annuities. And if you've continued to listen to me, you may have heard me talk about them in the past. In 2008, I became insurance licensed, September of 2008. And for those of you who remember that month, people's statements were coming in and it was pure panic because stock market was down 40%. So you had all these retirees. And at that time I worked with this company, and we would meet with 18, we would have 18 appointments per week. So do the math. I mean, that is a lot of people and a lot of stories. And what I saw was a lot of pain and people in their 70s who are retired or aren't going back to work, who are worried about running out of money and the stress that it put on them. And this is where and when I discovered fixed annuities. And the thing about these fixed annuities is that they were providing peace of mind. They were providing the ability to breathe and enjoy life still, even though, you know, the financial storm was happening. The financial crisis was here. And yet these people who were in their 60s, 70s, 80s, 90s, who had these fixed annuities were just getting their interest and getting their statements, and there was nothing changing. And so in times of financial, you know, fears, really, it's scary. The older you are, I think the bigger impact it has on you, because you know you're not going back to work. You know that this nest egg is all you have. And if it stops working for you to offset that deficit in your expense account, if your financial partner called your nest egg fails, you're in trouble. You're not able to go get gas. You might not be able to pay your rent, or pay, hopefully are debt free, but pay your electric. Just, it's so much fear. And the older you are, I'm telling you, the harder it is on you. I got a phone call 2008 Thanksgiving Day. And that year I made my best turkey, no lie. It was phenomenal. I'm not kidding. But I got a phone call while I was cooking that dinner, and I'll never forget it. And it was a lady that I had met with 2 weeks ago, and they had just moved to Florida from Kansas City. And he was so proud. They had this amazing penthouse condominium down in West Palm on the beach with this panoramic view. Like, you could see the beach, or you could just go over here and look at the intercoastal, and it was like the view just didn't end. And he was so proud of that. And she was excited, and they were having family come in. They were going to be the new, grandma and grandpa were the new vacation spot, right? And he pulls me aside. I was there talking about Medicare. I'm like 28 years old, just new to the Medicare world, and I'm trying to talk to him about Medicare. And he pulls me aside and he shows me his statements. And he is in a whispering voice saying, I don't know what to do. He's fully panicked. My advisor's not answering me back. I lost all this money. I'm not gonna be able to afford this place. I can't tell my wife, blah, 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 blah. He's talking 100 miles a minute and he is so stressed. And I'm just sitting there like deer in the headlights. I don't know what to do. I took the statement. I'm like, well, I'll try to call him. I'm sure everything's gonna be okay. And I was just super nice and sweet and left. And then on Thanksgiving Day, a couple weeks later, his wife called me and said he had a heart attack. Now, it crushed me. And if you think it didn't affect me and how I feel about this industry and how I feel about retirement planning and how I feel about what they call paper loss, that's not a paper loss, folks. That's poor planning. And I take it really serious because I know how it affects people. I know why he had a heart attack. I saw it in his face that day and I learned my lesson. And you know what? The families I had met time and time before who had these fixed annuities didn't have those problems. They weren't having heart attacks. They weren't having to explain to their wife why they didn't have enough money. So I'm going to bring this next guy on. His name is John Bussert, and he is my expert in the annuity space. So what John does is he's my wholesaler. He doesn't meet with clients one-on-one like I do, unless I call him and conference him in and make him talk to people. But he does all my research. He does all my due diligence. He's finding us the absolute best insurance companies, the ones that are best rated, the ones that are the safest, the ones that are going to give us the best interest rates. And he narrows it down. So there's so many options out there in the world of insurance, just like in the investment industry. I have all of these money managers that do the same thing, but it's all securities based. Well, John is my annuity expert. And if you remember, I had Mark on, who's my life insurance expert. Teams. So I can't know it all, but don't tell my kids that because they think I do. So let's call John and let's get the scoop on how safe are these annuities and how did they survive 2008? All right. I'm going to bring this over here so you can hear him too if you're on the Facebook Live. Uh-oh. Did I already mess it up? Okay. Here we go. Calling John.
Hello, Mindy.
Hello, John Bussard. How are you?
Pretty good. How are you doing?
I was worried you wouldn't answer.
Nope, I'm here.
Thank you. You always have my back when it comes to annuities, and I really appreciate everything that you do for me and my clients. And I thank you for taking my call. I know you're busy. So we are talking about annuities and first of all, how they survived 2008, specifically the fixed annuity. I know I do want to make the disclosure that variable annuities are actually tied to the market, so they do fluctuate. But what we're talking about specifically with John right now is the fixed annuity. So John, we've been talking about banking, we've been talking about brokerages, we just talked about real estate. Let's just compare it to a CD. And I'm going to turn you loose and just say, John, if I have a CD worth X amount of money at the bank, that's part of my nest egg, what are the benefits of having it in a fixed annuity instead?
Okay. Well, some of the differences between investing in a fixed annuity and a bank product, are really tied to some of the features that are related to wealth transfer. So, for example, when you have the money in a bank account, it can be tied up in probate for up to 18 months when you pass away. But if you put it into a fixed annuity, it is going to pass probate free directly to your heirs. So that speeds up the process that they're able to access the money that they need to be able to take care of their obligations and, of course, of anything left over from your estate.
Yes. And
in addition to that, sorry about that.
No, I was just going to add, I've seen how fast that is. And a lot of times the annuity money the family gets before anything else. So good point. Carry on.
Yep. So in addition to that, one of the other things is tax deferral. Now, you do get tax deferral on qualified money in CDs because you don't pay taxes, until you take it out for retirement. But if you have a scenario where you're investing with after tax dollars or non-qualified dollars, then in that scenario, you're actually able to carry over the interest that you earned the previous year free of taxes, and you're able to compound that interest on what you earn the following year. So it's called triple compounding, and it's basically interest on your interest, interest on money you didn't pay taxes on. It gives you the ability to rapidly outpace inflation, which I think you covered earlier, and also gives you an opportunity to keep up, with not necessarily the market, but definitely keep up with competitive rates of return without risk to your principal.
So I have a quote here, and you're right about that. If you do the math, and I could gladly sit with anyone and do it, it's how I was taught, is take $100,000 and just do 5% on each side. So every year you're earning 5%, but on one column, deduct the taxes that you have to pay. And you would be so surprised that just after 5 to 10 years, how much more money you have accumulated by the simple idea of tax deferrals. By IRAs are such a big thing, right? And now you can take taxable assets, non-qualified assets, and get that same benefit, correct? That's just reiterating what you said, right, John?
That is correct.
So I'm going to read this quote to you. Fixed annuity sales in 2008 rose 60%. So sales of fixed annuities climbed to $107 billion, up 60% from 2007. That's according to Beacon Research Fixed Annuity Premium Study by Bloomberg. And I'm curious, what are your thoughts? And I know last year fixed annuity sales it was up some crazy number. I had it on the last show, but it was in the like 70% or something really high. Why do you think that money is migrating to the fixed index annuity space? Obviously, one of the reasons is because of interest rates being higher, right?
Yeah, that's one reason, but also there's a flight to safety. I mean, there's some uncertainty in the markets. There's obviously been some volatility as of late. And of course, anytime you change, from a government from one school of thought to another school of thought, regardless of which direction it's going, there's going to be some uncertainty for the first few years until we settle into, the policies of that next incoming president. So it's not a scenario of, Republican versus Democrat. It happens in both ways. But one of the things that is important is people want, to create an opportunity where they have guaranteed yield and they have protection and safety. We don't have pensions like we used to in the past. Most workers aren't fortunate enough to have access to those. So we're now required to privatize our own pension. And that really puts an onus on us to be savvy about where we make investments and maybe even thinking more long term, not just what kind of yield can we receive on our portfolio, but of the yield that we receive, how we capture and keep more of it for our retirement.
Right. So I just did a scenario, and that's what I do when I'm planning for a retiree. We run all of these different scenarios. Maybe if you were, like, I'll call one the ultra aggressive scenario, the real estate investment scenario, a scenario where you're in 100% guaranteed products, but the safest, absolute safest scenario. Sometimes I'll do like travel the world scenario and just have people spending all their money before they die. It's fun. But one of the scenarios that I just did was a fixed annuity scenario. And it was literally, I haven't done, maybe ever done this, but the annuity quotes that John was sending me were high enough interest rates that it's performing enough over the next 10 years, locking in that return and having zero risk of market risk, that it's able to project an amazing retirement so that when they do retire, they have income protection. But even without the benefits of the income protection with annuities, just the fixed rate, it's incredible that we're seeing it now being used as a really huge foundation to build growth in, and I think that could be part of the reason that we're seeing a bigger move to that. The other thing I'd like to compare it to is really just the safety. We know that the state guarantee on annuities is similar to the FDIC, but one of the added features that makes them a little more secure is really the difference between with the insurance company and having the reserves and having the rating, right? Can you speak a little bit about what that is?
Yeah, so essentially, insurance companies are required especially A-rated insurance companies, are required to have roughly around $1 of cash on hand or in cash reserves in order to be able to take $1 of a client's money from an investment standpoint. So, and this is specific to fixed index annuities, not variable annuities. So, but what it does is it allows the claims paying ability of that company to rest on the shoulders of the company versus FDIC. Really, the bank is loaning money that you give them out immediately to other clients at the bank who want to borrow that money, and then they're earning an interest rate on that money. They only really have to have pennies on the dollar, and this is the reason for the FDIC, to be able to provide them some security and protection in the event that, you know, those loans are defaulted on or what have you. It's a little bit different with insurance companies. Another thing that you'll see is insurance companies also are, aside from cash reserves, they're also reinsured. And so if you think about insurance companies just inherently, they're really risk averse. They understand risk better than any other industry, and they're hedging their risk by reinsuring themselves against any potential for, you know, unforeseen financial circumstances.
Yes. And I think what you just said in those last couple minutes is exactly the crucial, I think, dividing factor of what sets them apart and how they survived 2008 and why why my clients or the people I was meeting day after day that had fixed annuities, fixed index annuities too, were not seeing losses even on the grand scheme of things. And I think it's because of the cash reserves and the risk mitigation that they're able to do because of the reinsurance. And again, it's insurance. It's what it's there for, is protection, right? So overall, it is, in my experience, a very awesome safe haven. And now when interest rates are up, you know, to be able to lock in a good rate for 10 years, it's pretty amazing. So I'm thankful for that. John, I really appreciate you coming on and giving us your input and knowledge. I hope you have a wonderful night, and I'll be talking to you soon.
Absolutely. My pleasure.
All right. Bye-bye.
Bye.
Okay. We have covered a lot of ground. We've covered a lot of ground. We have talked about banking, gold, silver, diamonds, and real estate. We talked about our brokerage accounts. We've talked about our nest egg. We talked about annuities, fixed annuities specifically, because I don't want you to get confused. There's several kinds. However, it's really just trying to find a place to invest your money and feel safe about it and know that you have protection. And hopefully you've learned some stuff today about the structure of these different elements and what they have to offer and really how you should use them. I'm a firm believer, again, in that expense account, emergency fund. That's what your bank is for. Nest egg. Let's use that to build a retirement, and let's use it when you retire to fuel your income and get you living the life that you deserve. Thank you so much for being a part. And if you have any questions, you can reach me, Mindie Molina, MINDIE.com. You can Google my name and find me all over. You can go on my YouTube channel and watch this show and see the recordings. Although today I had the camera backwards. Sorry about that, guys. And you can also go on my podcast, Investing for Retirement, Income for Life, and learning how to retire the way that you want and maintain your lifestyle. Most importantly, never run out of money. Do the things you want. Don't run out of money. Well, I thank you so much and hope you'll tune in next week, the Mindie Molina Show. And remember, God loves you. There's nothing anyone can do about it. Have a great night.